Many years ago, I worked out that I had pretty much the wrong end of the stick, and that sometimes alternative finance can be the place you want to go. And for example, was using that John Deere and Toyota finance. Quite often you'll find the John Deere or Toyota or many other companies will do deals, and they'll say our interest rate is a lot cheaper than everyone else because, you know, we're wanting to move more stock, more tractors, more John Deeres.
Yeah.
So is that what you find, that it's no longer people that are in trouble that use non-bank lenders?
I wouldn't classify that as that, definitely. Because there's such a broad array of offerings out there. You talk about dealership finance, they're huge multinational companies. So they've obviously seen an opportunity to try and attract more customers to buy their machinery. And they've got capital available that they can lend out to their customers at very affordable rates. Their main business is not making a return off that lending. Their business is moving more machinery, so they're using it in order to facilitate that. And in the livestock finance space where we operate, it's to facilitate, working capital needs that are there. It's a prompt turnaround time. I guess where people get drawn to it is the due diligence is not as onerous as a bank might be. It can be quite a quick turnaround, and it's for a specific purpose. So I definitely wouldn't classify it as being in trouble. When I worked at the bank, I maybe had the same impression that they can't get their money off their bank and they're going to go some elsewhere. But I definitely wouldn't classify it as that being the case.
So you've just mentioned a couple of the reasons there was it could be a cheaper interest rate in some cases, like we mentioned the equipment finance. It might be sometimes it might be more expensive. Also, you said a quick turnaround. Why else would people possibly use a non-bank lender?
Yeah, I think it's when you think about trying to manage your working capital in your overdraft and manage your account, you're trying to preserve that for running your business day to day, rather than making capital acquisitions like machinery or livestock with your working capital. You want to effectively ring fence that lending purpose to a particular vehicle. So in vehicle, I mean to a particular loan type or loan provider, from ease of management, but also just not to erode your working capital. What I've seen happen over many years is people will max out their overdraft, and when you do a review on their overdraft, they've got longer term liabilities or a build up of longer term debt in their overdraft. They're not necessarily their day-to-day expenses. So the other thing is that banks will often talk about their loan to value ratio, what's the property worth, and what's kind of leverage can we obtain from the property value. So they're really looking at the mortgage space. Clients who go to a non-bank funder, they want to preserve that equity and don't want to have an increased leverage on their mortgage, so they can use another vehicle to execute that, being livestock finance, equipment finance, whatever it might be.